Imagine being able to predict your financial future by learning from the past. Economic cycles, patterns that have repeated for decades, offer us insights into what's coming next. In this video, we'll uncover how understanding these cycles of interest rates, inflation, and more can help you make smarter financial decisions and navigate the challenges ahead. The history of interest rates: what goes up must come down. Interest rates are a critical tool used by central banks like the Federal Reserve to control economic activity. Historically, U.S. interest rates reached their peak in the early 1980s, with the federal funds rate hitting nearly 20% to combat double-digit inflation. Since then, interest rates have generally declined, reaching historic lows near 0% in the aftermath of the 2008 financial crisis and again during the COVID-19 pandemic. These low rates were intended to stimulate borrowing and spending to support economic recovery. However, as the economy strengthens, the Federal Reserve tends to increase rates to prevent overheating, as we've seen recently with gradual rate hikes to counter rising inflation. Understanding this cyclical nature of interest rates helps in making informed decisions about borrowing, saving, and investing. Understanding inflation and deflation: the economic tug-of-war. Inflation and deflation represent opposing forces in the economy. Inflation occurs when prices rise across the board, reducing the purchasing power of money. For example, in the 1970s, the U.S. experienced stagflation, where inflation rates exceeded 10%, severely impacting the cost of living. Conversely, deflation is the decline in prices, which can occur during economic downturns like the Great Depression, when falling prices led to decreased production and rising unemployment. While moderate inflation is considered normal and even beneficial for economic growth, targeted at around 2% by the Federal Reserve, both high inflation and deflation can be harmful if they spiral out of control. Understanding these dynamics is crucial for managing finances and investments, as they influence interest rates, wages, and the overall economy. The role of government debt: how it shapes our economy. Government debt is the cumulative amount of money that a government owes to creditors, often accumulated through budget deficits. As of 2024, the U.S. national debt has surpassed $33 trillion, a significant increase driven by government spending during crises such as the 2008 financial crash and the COVID-19 pandemic. The debt-to-GDP ratio, which compares a country's debt to its economic output, is a key metric. For the U.S., this ratio is now over 120%, indicating that the debt is larger than the entire economy's annual output. High levels of debt can lead to higher interest payments, crowding out other government spending and potentially leading to higher taxes or reduced public services. However, government borrowing is also a tool to finance critical investments in infrastructure, education, and social services. Understanding the balance between beneficial borrowing and unsustainable debt is vital for assessing economic policy and its long-term impacts. The impact of monetary policy: how the Fed controls the economic pendulum. Monetary policy refers to the actions taken by central banks to manage the money supply and interest rates to achieve macroeconomic objectives like controlling inflation, managing employment levels, and ensuring economic stability. The Federal Reserve's primary tools include setting the federal funds rate, conducting open market operations, and using unconventional tools like quantitative easing. For instance, during the 2008 financial crisis, the Fed cut rates to near zero and purchased large amounts of government securities to inject liquidity into the economy, a policy known as quantitative easing. These actions helped stabilize the financial system but also led to debates about long-term impacts such as potential asset bubbles. Understanding how monetary policy influences economic cycles helps individuals and businesses make informed decisions about spending, saving, and investing. Economic predictions: learning from the past to forecast the future. Economic forecasting involves analyzing historical data and trends to make informed predictions about future economic conditions. Key indicators include GDP growth, unemployment rates, inflation, and consumer confidence. For example, the yield curve, which plots interest rates of bonds with different maturities, has historically been a predictor of recessions when it inverts, meaning short-term rates are higher than long-term rates. Another example is how consumer spending trends can signal economic strength or weakness. Although forecasts are inherently uncertain, understanding past cycles, such as the patterns leading up to the 2008 recession, can help anticipate future challenges and opportunities. This knowledge allows for better financial planning and risk management. The rise and fall of asset prices: understanding market cycles. Asset prices, including stocks, real estate, and commodities, fluctuate in cycles influenced by economic conditions, investor sentiment, and external factors like government policy. For example, the dot-com bubble of the late 1990s saw tech stock prices skyrocket before crashing in 2000, wiping out trillions in market value. Similarly, the U.S. housing market experienced a significant boom in the early 2000s, followed by a dramatic crash in 2008, which contributed to the global financial crisis. Understanding these cycles helps investors recognize when markets might be overvalued or undervalued, enabling them to make strategic decisions about buying, holding, or selling assets. Diversification and risk management are key strategies to navigate these cycles successfully. The job market is constantly evolving, influenced by technological advancements, globalization, and economic conditions. The Industrial Revolution is a historical example of how technological innovation transformed labor markets, replacing manual labor with machine-driven production. Today, similar shifts are occurring with automation and artificial intelligence, which are expected to displace certain jobs while creating new opportunities in tech-related fields. According to the World Economic Forum, by 2025 machines could displace 85 million jobs, but create 97 million new roles in fields like data analysis, AI, and green energy. Understanding these trends is essential for career planning, emphasizing the need for continuous learning and adaptability to stay competitive in the job market. Investment strategies for the next 40 years, adapting to economic change. Investing strategies must evolve in response to changing economic conditions. Over the past 40 years, a buy-and-hold strategy in the stock market has been highly effective, given the long bull markets punctuated by occasional downturns. However, with potential shifts in interest rates, inflation, and global economic dynamics, future strategies may need to be more diversified. For example, as interest rates rise, bonds may offer more attractive returns, and real estate may provide a hedge against inflation. Additionally, investments in emerging markets and technology sectors could provide growth opportunities. Understanding these shifts can help investors adjust their portfolios to protect against risks and capitalize on new trends. The impact of technological advancements on economic cycles. Technological advancements have historically driven significant changes in economic cycles. The Industrial Revolution, for example, drastically increased productivity and economic output, leading to sustained economic growth. In the modern era, advancements like the internet and automation have similarly transformed industries, increasing efficiency but also displacing jobs. The rise of artificial intelligence and machine learning is expected to continue this trend, potentially increasing productivity but also creating challenges in labor markets. According to McKinsey, AI could add $13 trillion to the global economy by 2030, but it will also require significant investment in skills development and education to mitigate the impact on workers. Understanding how technology influences economic cycles helps businesses and individuals anticipate changes and prepare for the future. Global economic shifts. How international trends influence local economies. In a globalized economy, events in one part of the world can have far-reaching impacts on local economies. For example, the 2008 financial crisis, which began in the U.S. housing market, quickly spread to other countries, leading to a global recession. Similarly, trade wars, such as those between the U.S. and China, can disrupt global supply chains, impacting prices and availability of goods worldwide. The rise of emerging markets like China and India is also reshaping global economic power dynamics, affecting everything from currency exchange rates to job markets. Understanding these global connections is crucial for making informed decisions about investments, business strategies, and government policies. As we've seen, economic cycles are not just abstract concepts, they're the rhythm of our financial world. By understanding these cycles, we gain a powerful tool to navigate the future, whether it's recognizing when interest rates might rise, preparing for inflation, or adapting to the latest technological shifts. The lessons of history are invaluable. As we move forward, let's keep these cycles in mind, using the wisdom of the past to inform our decisions today and secure our financial well-being for the future. If you found this video helpful, don't forget to like, subscribe, and share your thoughts in the comments below. Let's continue this journey of financial discovery together.